To a little bit of form. Look, a lot of talk about short covering underpinning the gains today. Is that the case? And if so, how sustainable is that?
That's a good question. No doubt that short covering was behind a lot of the gain that we saw today. And that was due to some positive comments coming through from China. We heard from Premier Wen Jiabao saying that China is going to look at policies that support growth. And that was, of course, good news for the miners. The short squeeze seeing some good performances. BHP, our largest stock, up by 2%, and Rio Tinto gaining 1.4%. And also, if we have a look at the banks, they did well with gains of 0.4 to 1.2%. We saw a few results coming out to market. James Hardie coming out with its full-year result, that stock down by 1.4%. And Campbell Brothers was the other company coming out with its full-year result, that stock down by 1.1%. And interim results coming through from Technology One as well as Elders. Elders down by 1.4% after its result, while Technology One was flat. But altogether, the market's still keeping one eye on what's happening in terms of Greece, and of course, with the Australian market so strongly weighted towards the Chinese economy, we're keeping one close eye on China as well. In fact, in just the last few minutes, we've seen over Dow Jones Newswires, China confirming that iron ore imports in the month of April was down by 8%. We are seeing a reaction in terms of the Aussie dollar. If we have a look at the Aussie dollar in the last few minutes, you can see that we've seen quite a sharp sell-off, now trading at the lows of the Asian session. And of course, Thursday is going to be important for that, where we do see the HSBC flash PMI numbers, and we are expecting to see a contraction.
Defensive still very much being the order of the day for a lot of investors. Do you see risk starting to come back into vogue or not so much?
Well, the funny thing about today was that the defensives did well. We saw the telecom sector, the second best performing area on the market after the materials space. So while we saw those growth areas doing well, the miners especially, probably due to some short covering, we did still see a strong demand for those defensive areas. And we're certainly seeing that through some of the floating rate securities as well. We know that NAB was looking to raise $500 million last week through its subordinated note issue. We found out this morning that they're now looking to raise double that, $1 billion. So in line with the experience that we've seen with ANZ as well as Westpac, where we've seen the latest issues of those banks being upgraded to a much larger amount. In terms of ANZ, they were hoping to raise $500 million. It was $1.5 billion. And with Westpac's convertible preference shares hoping to raise $750 million, it was $1.2 billion. So still those defensive assets very much in vogue, and that will be the case as long as Europe takes most of the headlines. And I guess a link to that is China, because Europe is still China's largest trading partner. It's still the largest export market. China's not strong enough to support itself just through domestic consumption, and it still does rely on that export demand. And unfortunately, in terms of Europe, it's one of the largest markets, and we're not seeing too much of it at the moment.
Do you see, Julia, do you have faith in the capacity for authorities in China to, if need be, stimulate growth there? They're not sort of on the same sort of growth trajectory they were during the global financial crisis, maybe not the similar sort of firepower. I mean, there was pretty much the biggest stimulus spend in history during that GFC.
Well, if you have a look at during the global financial crisis, we saw massive stimulus come through from China, but at the same time, we saw our miners seeing a huge downturn in terms of the share price. It didn't stop BHP share price from going to $20, Rio Tinto's. I guess this time around, we're a little bit more aware of what to expect in terms of our markets, in terms of economies, and in terms of Europe, there's a bit more in terms of the mechanisms. It's just a matter of cashing up those mechanisms now to try and help countries like Greece, Spain also very much in focus, and whether there is enough money and whether Germany or other countries are willing to pay. So I guess Europe's still very much in focus. China certainly has the capacity to stimulate, and that should help the domestic situation, but with one of its largest export markets down, it's not going to do much to help stimulate its export market to Europe.
Yeah, David, to some of those geopolitical issues later in the show, but I wanted to get your thoughts on Qantas, Julia. The big announcement, not exactly a surprise, however, from Alan Joyce. They've come to the end of the heavy maintenance review as such, consolidating their 3 maintenance hubs into just 2, and as a result, 500 jobs will be lost. Was there much of a reaction on markets?
Not a huge reaction at all. In fact, the shares ending flat at $1.43. This was well flagged to the market. Qantas earlier on the year saying that it is looking to close one out of the three of its heavy maintenance facilities here in Australia. And we know that Qantas is undergoing aggressive cost cutting. It's hoping to save $280 to $365 million between this current financial year and FY14. So if we have a look at Qantas, still battling those very high jet fuel prices, oil prices are still relatively high, still holds about 65% of the local domestic market, but of course facing some tough competition from the likes of Virgin domestically, and then internationally we have some capacity coming on board with the likes of AirAsia as well. So aggressive cost cutting by Qantas, not a surprise to the market here, and the shares finishing flat.
In your opinion, your personal opinion, Julie, I mean, does it hold much of a bright outlook? I was talking to Peter Escher, which no doubt viewers will be familiar with from City Index, and he was reasonably confident on the outlook. He was talking about it trading at a discount to its book value. He talked about the fact that it does have, like, it's still earnings, there's accretive, there's still profits being made there, and with some of the moves they're making, it perhaps makes for a brighter outlook. Many in the market would disagree, but that's what makes the market, I suppose. I mean, where do you sit with Qantas as an investment option?
I think Qantas is stepping in the right direction, aggressive cost cutting, cutting of its capital expenditure plans as well, and trying to get its international business to a break-even status within a number of years. But a stock like Qantas and airline stocks are cyclical stocks, so they move in line with the global economy. And if we have a look at the macroeconomic outlook, well, things are a little bit tough at the moment, and if we do see a crisis in Europe, then that's going to have an impact. You only have to look towards the global financial crisis to see what slowing global growth does to airlines. We saw a number of them going belly up. This is an area which is impacted not only by the volatility in fuel prices, but a large amount of capital expenditure as well. So when times are good, airline stocks usually do very well, but when times are bad, this is a cyclical area, so an area to be cautious around. Qantas, one of the best managed airlines in the world, so best of breeds, but it is still a cyclical stock, so watching that European situation and the impact on global growth very carefully.